Keith and Darryl, what's your principal opinion on dollar cost averaging down on a position? This is an interesting one because I've thought about this a lot. Part of my job is I manage best ideas portfolio, which is just our ideas for a client.
Yeah, with real money.
With real money.
Yeah.
So Keith and I talk about that a lot, and actually, I think dollar averaging down can work in some markets, but it doesn't work in markets like this. And Keith actually, you would show him the portfolio once in a while. He'd basically tell me, I would sort of be dollar averaging in. He'd tell me, you got to sell this, you got to sell this, and he's right because that's what the signal is basically telling.
Yeah.
So I think it sort of depends how well you know the position,
Yep.
what type of market you're in. Interesting anecdote. Paul Tudor Jones, I think, is the investor, but I guess above his computer he had a little sticky note that said only losers average losers, which I thought was pretty funny.
It's a great conversation.
Yeah.
All right, let's take a little bit more time today, just because I'm so happy and Steve's so pissed. We got it a better place for Steve, but a lot of you really are happy, and I'm happy for you for that. All right. Again, I'm not trying to appease anybody's feelings, but again, I'm trying to teach it. All right. So instead of using the asset allocation, which thank you, many of you are teaching the other users. Some users had some trouble trying to add up what the asset allocations would be. I don't want to review that. What I would do is go back to where I grew up in this business, which is basically as a long short manager. Okay, so I have rules. My max long position is 6%, right, Jonesy?
Yep.
4% I'm in the middle, 2% I'm at a starter. Okay, what you're asking is how do I get to this, all right? On the short side, 3% max, 2%, 1%. So, by the way, a lot of people actually don't even know how to be set up structurally, right? Your longs should always be bigger than your shorts. You should, if you could, have actually more shorts because there's more optionality, particularly in a bear market where stuff just shits the bed.
And more risk, right? Because
Yeah.
they could double against you.
Yeah,
right?
exactly.
Yeah.
So we set it up that way in particular, but it's not averaging in, it's getting into a position. So again, once I go here, so I typically go 25 to 50 basis points at a time. So all that means for those of you that don't know, and I do talk in basis points. So 0.5%, that's 25. So again, if you do that 4 times, you're at 2%, right? If you do that 8 times, you're at 2%. So in this day and age, you don't have to pay commissions. That's the best part, right? John Dawson, my old boss, used to rip his whatever hair he had left out, trying to understand why I traded so much because I would just leak commissions. Street loved it, right? That's how I got to go on all these great golf trips. How I blew up at Bandon Dunes, short Reebok. John's on the phone, wanted to fire me. I was as close as I was at that point in my career getting fired, by the way. So I got a lot of experience with this stuff. All right, but what I do when I call the desk, when you call the Dawson Sandberg desk, Dawson Herman desk at the time, I call Pat Feeney and I say, hey man, buy 25 basis points of Nike, buy 25 basis more of Staples, buy 25 basis points of McDonald's. Those are my longs back in 03. That's what I do, right? And I'd literally call them, right? So the trader would put that in. I don't say, bro, buy 100,000 shares. What does that mean, right? If the stock's $100 or it's $10, that means a lot different. There's a big delta there in terms of the capital. So what you want to do is commit to what you're doing in the position, right? Okay, here's my goal. I want to get into this position. Now, what a lot of people do is that they'll only add once they get to this thing, Jonesy, which is I think what you're asking. If this thing starts going against them, they'll go right to this level.
Yeah.
They'll have now a 6% position in a loser. Okay, now I've fucked this up so many times I can't even count, all right? And over time, you're going to screw this up less. It took at least a decade for me to not do it this way. Because as a value guy, that actually works in 2002, 2003, because I was buying. I went from bearish to bullish in 02, and every dip you bought worked. So actually, if it went against you for a little bit, it would eventually go up, because we're about to enter like a raging bull, right? But once that turned, that doesn't work. This is why value guys implode in bear markets, right? Because they're buying what they think is cheap and it keeps getting cheaper. What you want to do is actually quite the opposite. When something starts to work, let's say we got 1, 2, 3 positions that are working versus 3 that aren't working. You want to take those winners up faster, get them grossed up because your winners win. It's like playing your best players, right? Shitty coaches play everybody, right? Great coaches play their best players for every best scenario that they're good at, right? That you should see the ice. I am not democratic in terms of ice time with 12-year-olds. All right. So again, this is you ride your winners, right? And I had this discussion with a very close, again, same hedge fund guy that I'm talking about yesterday when I was telling them, hey, good spot to get net long. I'm like, when something starts working for the right reasons, press it, get bigger in it. By the end of the day, there's no transaction cost to this. Okay. I can go from 2% long a position to 6% in 25 minutes, and then 2 hours later, take it back to 4%. That's how you play aggressively, right? That's how you play having a market view. Like when I'm covering shorts, Steve, that's what I'm thinking, right? If it pisses you off because you don't understand that, I think a lot of people right now are thinking, that guy knows what the hell he's doing. Steve, shut the fuck up, right? I mean, this is how you play the game for real. And I think the faster you learn not to average into losers and to ride your winners and to have a plan. Have a plan. What is your master plan? 642, 321, 25 beeps, 50 basis points at a time. If you want to do it differently, great. All right? But have a plan.
I think the other thing people ask us a lot about is stop losses, and I've done a lot of research on this. A lot of different philosophies around that, but to your point, find a stop loss plan that fits your personality, your style of investing, and stick to it, right?
Yes.
Develop your own process. We think we're providing a lot of tools, a great framework for you, but you got to have your own process as part of all this, or it just doesn't work.
The best thing, and it's the hardest thing for me to come to terms with, even if you look at the history of me in real-time alerts, like there are periods like when, like go back, you have 13 years of history. Some guy asked me the other day on Twitter, did you really buy Starbucks like in April of 2009 and hold it for this long? I was like, yeah, I was just trying to prove that I could be like Warren Buffett. But one good rule on stop losses, so build out your positions to this level, 2%. And stop yourself out, like instead of buying more, once it starts going against you, just chuck it. Stop it out. It's not even stopping out at a level. It's just that it sucks. It's like you put the wrong player on the field. Just get it out of there. That's how I think about stop losses. I don't wait for it to go 12% against me. If it's not 2-3% for me, get out of here. Go to the curb. Sit on the bench. I want somebody who can play, right? So let's find some more horses to ride. That's the way to think about it. I think, and again, that's my learnings over time are largely a function of all my mistakes, to be clear.